Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we interview value investor and portfolio manager Jeff Muhlenkamp.
And today Corey and I will talk about a stock that has been around and around many times on many episodes of the podcast, Disney.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Disney. Let's talk about Disney. So let's see. We broached this topic a few weeks ago with Porter Stansberry, and we brought it up again more recently with Whitney Tilson. We may have mentioned it at another time. I don't remember all the times we mentioned it, but I remember those two. We had a bit of discussion about it, and a little news item about it caught my eye recently, which is that one of the three activist investors who have gone after the company in the past couple of years here made a deal with the company. And the firm that made the deal is called ValueAct. It was started by a pretty famous value guy named Jeffrey Ubben. He stepped down and handed it over to his protege a year or two ago. And I saw several good presentations over the years at the old value investing conference that Whitney Tilson used to run of Jeffrey Ubben. Always really a thoughtful presenter. And the focus of the firm ValueAct was to kind of work with management behind the scenes to keep from getting in nasty proxy battles, right? And the other two activist investors were Trian, run by Nelson Peltz, and Third Point, run by Dan Loeb. I never saw a Peltz presentation, but I saw a few Dan Loeb presentations over the years. Really smart guy. And so those two are a little more of the, nasty proxy battle, writing the inflammatory letter kind of guys. Especially Loeb. He's written some hilarious letters. So it doesn't surprise me that they made the deal with ValueAct rather than, with the other two. Although they took some actions, it seems like after the other two, like when Peltz first got involved, they let thousands of people go, and they cut expenses and did a few things because Peltz's whole deal was about their poor operating performance. And so now they made this deal with ValueAct, under which, I'm just going to quote the Wall Street Journal here, under which the activist would back the company's board nominees at the coming 2024 shareholder meeting, and Disney would share information and meet with ValueAct. And it said, indeed, Disney's pact with ValueAct could help inoculate it from the pressure of Peltz's demands for board seats, in a contentious proxy season. It says, yeah. So they don't want to be contentious. They want to get ValueAct on board and work with them. But I looked through Peltz's presentation, a bunch of slides dated January the 12th, filed with the SEC. Like, it was all the standard, the share price hasn't performed and the operating performance hasn't been good and your streaming strategy isn't that great. Nobody addressed what we've talked about on this show, which I feel is like the elephant in the room, which is kind of the, just the wokeness of the content alienating people, because that's not what you go to Disney for.
Right. Yeah. This seems like just a personality clash too with on Peltz's and in his group. There's the former CFO of Disney who got passed over to replace Bob Iger. And so I think that's part of it too. Like, how should we steer this company just from a broad view, and the political parts of it too. I mean, it's amazing that a company like Disney, which I know has been long recommended before I started at Stansberry Research as a stock to buy, with with all the trophy assets and its collection of just copyright and IP and the parks and everything it has going for it, is just in a place where activist investors are fighting over the future of it and debating the direction. And it doesn't seem like there's a clear answer. There's a lot of issues with Disney on all kinds of fronts now, from the content itself to like streaming. Nobody's making money in streaming, including Disney. They have ESPN, which is just like a big loss. Not even leader at this point. It's just that the whole cable business has been turned upside down, and streaming's not working for anybody except maybe Netflix. Yeah, it's just for a company that still is, last night with my kids, they want to put on Mickey Mouse to watch. Like, it's still got that brand awareness, and where you just kind of want to go to it. A lot of people want to just watch it, right? From just generations of memories. And now it's, I don't know, the future of the entire company. Well, everything you're explaining, as well as the content side, is just completely muddied.
And almost concurrent with the announcement of the deal with ValueAct is the announcement that a woman named Charmin Obaid-Chinoy is going to direct the next Star Wars film. She's a two-time Oscar winner, and she directed Ms. Marvel, which is part of Disney's Marvel Cinematic Universe. It's a miniseries that follows the heroine Kamala Khan, the first Muslim superhero in the Marvel Cinematic Universe, and she's making some waves based on a comment that she's hired to do the next Star Wars movie, but she's kind of making waves based on a comment that she made like 8 years ago, like or more than 8 years ago, in 2015. But I found the question she was answering when she made the comment that everybody's reacting to. And so I want to read the question because it's insane. And she was at the Women in World Foundation panel in 2015. And Chinoy was asked this question: what is the balance of activating a force for change, but also trying to permeate that patriarchy, that power structure? And is that a part of the calculation of your art as well? And what's been the reaction to that? And Chinoy replies, it's a crazy question, right? It's insane.
By Jon Stewart, by the
makes
way.
no
But
sense.
that was Jon Stewart who asked that question, which is bizarre to me.
Oh, that is weird. Yeah. And she says, "Oh, absolutely. I like to make men uncomfortable. I enjoy making men uncomfortable. It's important to be able to look into the eyes of a man and say, I'm here, and recognize that." And she went on from there. But, what my first thought, and I posted this on Twitter as soon as this stuff kind of came out, or on X, formerly known as Twitter. And my first thought was, whew, it's a good idea that men aren't the ones paying for their families to go see Disney movies, because they might be really uncomfortable enough not to want to do that anymore. And then, then I see this thing about ValueAct, and I know, Peltz has been after it, and Third Point's been after it, and this other firm called Blackwell is now getting involved. So all these investors are coming after it. And I felt like their response is, hire this woman to do a Star Wars film. It was, it's what's wrong with it on the one hand, and the result of all these investors coming after it on the other. It just seemed too perfect to me.
Yeah, it's for that clip to be brought up from 8 years ago, which it was from a commentator online, because in response to a like very recent interview she did on CNN about how it's 2024 and I'm glad a woman is going to be able to basically direct Star Wars, which fine is fine on its own, But then when you then or people would read those other comments or hear the other comments, is very much goes to the alienating sphere very quickly, when it's kind of telling you how you should think. And we're both white men here, so we're gonna have an opinion on it, and that's fine. And other people can have other opinions too on whatever else it is. But I think the point with Disney and other companies that like Whitney Tilson talked about a couple weeks ago with us, like where's the value in alienating however half, 25%, 1% of your customers. Like we're seeing it more and more and more now, and I think you're seeing the pushback from the quote wokeness, push, whatever you want to call it, the last couple of years. Which
Mhm.
there's good things to being more culturally aware, right? There's some good
Sure.
things there, but when you like push it down people's
Absolutely.
throats about movies or beer or whatever it is, like these are not things I think most people want to be caring about. And then you see it in sales, like with Bud Light. You got
Yeah.
I read yesterday their sales are down 25% from this time last year, and they're no longer the number one like beer brand in America. Like I would have never thought that would have happened. Like as much as like I would have never in my
Yes.
mind thought that
You're
was happening.
right.
Same thing with Disney. And these are the things that I think they're well intentioned at some level, but they're going about it, in a poor way that pisses off a lot of other people.
Yeah, there's gotta be a way to do this without, um, you know, just at the most fundamental level of understanding. You can say we want to do things for women without saying we want to do things against men, right? And this does have Bud Light written all over it. And she seems, she's won 2 Oscars, and she's done this other, kind of action type film in the Marvel Cinematic Universe, and, like, she's got all the talent, it seems, that you'd ever wanna have, but it's interesting to me how, like, one comment can overshadow all of that. And let me ask you this, um, who says, "Gosh, I can't wait to get lectured about being a man in the next Disney film." Like, you're going to see Star Wars, it's in a galaxy far, far away. You wanna get far, far away from this world and all of its squabbles, and you wanna see a epic battle for good and evil. And and frankly, I think people have enjoyed seeing men and women in these traditional roles, and Princess Leia was a great leader. She was a she wasn't like a '50s housewife or anything. She was a strong female character, and there were others in the old Star Wars franchise. So, if you want more of those characters, there's what's the harm in that? That's great. Bring it on. We love those characters. But you don't have to say, "I wanna make men uncomfortable." I mean, I heard it and I laughed. I was like, "That statement is not gonna sell tickets." I don't think, or streams or whatever you're trying to sell. It's just
Yeah,
it's a
right.
little silly.
And
So
again, this is like a comment from 8 years ago. I have no idea like what she would say today. I suspect something different. But I did take a issue, and I think other Disney like people who are interested in Disney programming, like she said, it should make you uncomfortable because you need to change your attitude. Like that's the stuff like with businesses, like when you're telling somebody what they should think is where I think people and the pushback comes of ultimately, in terms of purchases and buying behavior, and can lead to problems for a giant, formerly great company like Disney. Like it's like self-inflicted wounds. It's like I'm reminded of
yes.
what Whitney said. Most CEOs would just be the policy should just be do not say anything about it, like about anything other than your business, really. Which I think is how it. I don't know if it's fair to say that's how it used to be, but like I don't know, with social media and just everybody has a platform now. I think it's very easy to get sucked into sharing your opinion on something for no real good reason, especially if you're who am I to say? I'm not a CEO of, never been a CEO of Disney or Anheuser-Busch, but um, I don't know. The numbers are what they are.
Right. So, here we are, we've got, now, if you include Blackwell, which was mentioned in the ValueAct deal, 4 activist investor firms coming after this thing. and getting each one of them got some sort of a result that they liked. So, but I'm still not there. I'm still not. Normally, any one of these firms could get involved with a company, and you'd say, "Oh, they're going to change it." You know, the stock hasn't gone anywhere. They're going to change it. Peltz has a whole case study of their involvement in Procter and Gamble, and I thought, yeah, but Procter and Gamble wasn't saying they want to make men uncomfortable. So I I'm still not there. I'll probably want to buy this thing when it's already up 30%, because it was 80s. It was like $80, and ValueAct said they thought the parks and the consumer products were worth $80 a share. So they were willing to pay that, and they thought the rest of it could be, um, they could get involved and get the value of the rest of it recognized in the market. So, there's $10 a share. I don't know what they think the ultimate value of all the rest of it is. But it seems to me like the problem, I think the Bud Light problem, is still there. And so I don't know, maybe that's the time. Maybe now's the time to buy it, though, because she came out with this statement that makes me cringe. The new female director of the Star Wars film came out with this statement that makes me want to cringe. But there are four value, oriented activist investors going after this company. So the sharks are circling. Everybody wants results, and the sort of wall of worry issue is maybe I shouldn't worry. Maybe the director issue is a distraction, and I'm wrong to not want to climb the wall of worry and buy the stock.
Right. Yeah. I think if you believe in the company still and think that it'll, these things will resolve and the leadership will get sorted out one way or another, yes, maybe now would be a time to think about buying. The stock's essentially flat. I was looking at the other day since the March 2020 pandemic lows in March when the market crashed, and the Disney stock was up about like 5% last year versus the S&P. It was up over 20. So it's been lagging the stock itself, but that's if you believe in it still, and if you think things can get turned around. And there's no guarantee that even if like a strong leader or leadership and investors do commit to this company, that they can turn it around either. Because I think what Disney had decades ago and even 20 years ago was they had like the advantage of their content and having it and the distribution and being like one of the few major players in the whole game. Today there is how many streaming services are there now? How many theme parks are there now? Like if you make a misstep and a mistake with a Star Wars director or whatever, something that alienates somebody, if you make a mistake, there are like a million other places you can go to watch something. You could go to YouTube TV in a second. You could go to Netflix. You can go like YouTube and Netflix did not exist when Disney started, right? Like those things are these are relatively new developments for them and competitors, and so I don't think I don't think they fully appreciated that over the years. Same thing with ESPN. I mean, ESPN made its money over being like first to figure out cable bundle subscriptions. Like that was, and it's just slowly eroded away. And so whoever takes over, whatever group ends up forking over the most money and winning the most board seats, needs to figure out that part of it too.
Yeah. So two things. One is I've got a chart in front of me. The stock has actually gone sideways for 10 years. You're right. It's back to that COVID, but even that, like the first time it hit these levels, where it is trading today around 90, 91, was in 2014. So it's gone nowhere for 10 years. But you make a good point about making a misstep, because we view all of this content is like there's nothing like it. Yes, you're right. There is competition, but I think your point there is nowadays Bud Light proved you can make a misstep that just eliminates that effect, that branding effect in people's minds, where we just got to have Bud Light. We don't even question it. We don't want anything else. This is what we got to have. And it's possible to make a misstep really quickly to just sabotage that and destroy it. And my fear is that saying you want to make men uncomfortable in your Star Wars films is that level, and that's going through all the content now. That's the wokeness. And yes, your kids will always want to see, just go back in time, Aladdin or Little Mermaid or whatever those older films were that your kids just got to have and watched 100 times. But it's possible. It's almost unfathomable to a parent who knows that, like, there's no substitute for that thing that your kid loves. But it's possible to ruin that. And that's what we're looking at here. Have they ruined that? Are they approaching a Bud Light moment? Have they already had it? Are they in the midst of one? I don't know.
Yeah, I mean, it's hard to please everybody, and so yes, there's Disney things that I watch now from 20 or 30 years ago that make me go, oh wow, I didn't even realize that was being said when I when I was watching that originally.
Yeah.
But like, I don't know, it's you still, this is the world we live in. Like, you can't it's not perfect. It's not. I think we do do ourselves a favor by just, like, I don't know, addressing the real problems rather than trying to project the like do it through imagery and positioning and marketing. Like, that's not the way to I don't think that's the way to build a long lasting brand this right now. Like, I think we're clearly seeing, I mean, it also contributes to, like, just polarization and the kind of, like, tribalness of everything we see in all walks of life. Like, if you're okay with a certain media company or product, it like, now it's supposed to, like, mean something about yourself. Like, I think we just need to try to get past all of this, and I think the companies would be better served to do it too.
Yeah, just looking at a stock chart real quick. It seems like before the stock price really kind of bottomed out and took off in 2011, I mean, it was sideways back to like 1997 from that price. So this has happened before. You know, you go sideways for however many years it is, you know, 10 now. And then somebody comes in and realizes how unbelievably great Disney is. And I wonder what the stock looked like when Warren Buffett, I remember Warren Buffett bought it many, 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 many years ago. And I think he made like 50% in a year or so because it was way down. And then he promptly sold it, and he could have had this major, major multi-bagger, like probably bigger than Apple or something. So this might be that again. This might be another opportunity to get at Disney after many, many years of sideways and not, the thing is not, something's not working right. So this could be it. I don't know. I'm not willing to say, yeah, pound the table, buy it now. But I recognize that I might be making a mistake in not doing that. I don't know. That's about where I am. I can't improve on that.
Yeah, me personally, I mean, I'm not convinced on, there's other things I would look at, but that's just personally. And if you look
Mhm.
at Disney, it is a, it's not necessarily, I mean, yes, I guess it's connected to the business cycle from their theme parks and consumer end, but its media library is, you know, stood the test of time. So, and what it can do with that, and no matter who's been in control of the company. So, if you believe in that core business and being able to generate all kinds of profits off of all things that some of them haven't even been developed yet, right, for the next 10, 20 years. So, if you believe in that, then yeah, I'm looking at the chart too. It looks like, it's in a similar, it's almost identical to what it looks like after the .com bubble.
Right.
And
Yeah.
so, yeah, and maybe it is time.
All right. Well, that was fun. Now let's have some fun and talk with our guest, um, Jeff Muhlenkamp of Muhlenkamp Company, great value investing firm. Let's talk with Jeff Muhlenkamp. Let's do it right now. NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular on many major news outlets from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzyreport.com. Again, that's www.aifrenzyreport.com for a free copy of his new report. Jeff, welcome back to the show. Good to see you again.
Good to see you, Dan. Thanks for having me back on.
So, Jeff, it's been a little while. Last time you were on the show was August of 2022.
Yeah, that's been a little bit.
Yeah, that was an interesting year. We've had another interesting year since then. Who could have predicted? I would have thought in August 2022, this is a 2 or 3 year bear market all day long, and hold on to your hats. And 2023 just surprised the heck out of me. Did it surprise the heck out of you?
It did. So much like you in the fall of 22, my mindset was that the bull market we'd seen in tech, call it a bubble if you want. I think it had a lot of aspects of a bubble, had started to pop. I thought, that had started to pop in the summer of 21. I thought it had probably done about half of what it was going to do. You looked like you were running into a recession. So what happened, in late 22, in October, really, when the bear market or whatever you want to call it bottomed, a couple months later, I was thinking, what changed? Well, what changed was inflation numbers started to come down. So as inflation numbers started coming down late in 22, early in 23, you started to see things like Microsoft and big tech start to turn around a little bit. And then that just got kicked in the pants. It got a turbo boost come March, really, when ChatGPT hit the airwaves and everybody was all excited about AI. And the banking crisis, and I think it was a crisis in the regional banks, wasn't enough to derail that, which was amazing. So the banking crisis really wasn't a surprise in the fact that it came. The form it took was a little different, and I wasn't trying to predict that. I figured we would have a problem, and we did have a problem, but it didn't derail the bounce or the bull market, whatever you want to call it, and it really didn't change what the Fed was doing, which I thought it might. So yeah, I think 23 was very surprising, and so now you're saying, well, didn't expect that. Where do we go from here?
Yeah,
and that's a head scratcher to me.
So the chatter, I spend way too much of my life on Twitter. So when I say the chatter, I probably mean stuff I read on Twitter. The chatter is sort of, among folks who I think are kind of pretty savvy watchers of such things. The chatter is that the Fed has to do something. They have to kind of thread a needle between wanting to cut rates on the one hand because they see the headline inflation numbers falling so much, but not rekindle inflation on the other hand because the economic data doesn't say that there's anything particularly wrong. Labor's still tight. Housing prices are still high. And, with mortgages coming down off of, what was it, 8% or so, now, below 7, that's looking a little better. Starts were up 18% a month or so ago. There's no reason to look out right now and say, oh my God, it's all falling apart. We need to cut rates. So I don't know. What's your reaction to all this? Like what? Let's see.
So, I think there's plenty of ammunition for whatever case you want to make. So if you want to say, we're still heading for recession, you can look at manufacturing PMIs, you can look at manufacturing levels, you can look at the LEI, you can look at just a broad array of data points that look very recessionary, starting with the inverted yield curve. It's still inverted, right? Oh, well, the Fed's going to, drop rates and it won't be inverted. Well, if you look at history, normally the recession occurs once the Fed has started, dropping rates because of the lags involved, right? So you can make a pretty decent argument that we may still get a recession. And then, as you highlight, if you look at another set of things, housing market's one of them, right? New home sales are still looking pretty good, even though the existing housing sales are still in the toilet because nobody's interested in trading a 3% mortgage for now a 6.5% mortgage. That's still kind of got the existing housing market in the deep freeze, if you will. But there are a number of things out there that, things aren't getting any worse. The commercial real estate market isn't getting any worse. Banks now are in a better position than they were 6 months ago because long rates have come down, so the value of their holdings is looking a little better. That frees them up a little bit. So it's very much a mixed bag to me, and one of the big things that is happening now that I don't think gets enough attention is the deficit spending of the federal government. We're spending, we've got a 6.5% of GDP deficit. That's a wartime level of spending. And it's, the government doesn't borrow that money and save it. The government borrows that money and spends it. So it's all getting pushed out into the economy. So you've got extremely loose fiscal policy. At the same time, you've got arguably reasonably tight monetary policy, but in the last month or two, the whole financial system has kind of operated to loosen up financial policy. So when interest rates drop, when the 10-year dropped from 5% now to 4%, well, that was a big loosening. When mortgage rates went from 8 to 6.5, that's a big loosening, right? So it really is a mixed bag, which makes it, again, it's a head scratcher. There's no easy prediction. Oh, this is what it must be. This is obvious to everybody. You can really support pretty much any argument you want. And so, for you and me and your listeners, the question is, well, what do you do with all that?
Right.
And so I would say for starters, don't place all your chips on one outcome, right? So don't say, oh, well, I think it's likely to be a recession, and so I'm going to optimize my portfolio so it will do well in a recession. But then it won't do well in a continued expansion, or it won't do well in an inflationary environment, or the other possibilities that we may have. So, the way I'm looking at it, and the way I would suggest, it's useful to look at it. What's the spectrum of what may happen, and then each part, your portfolio ought to be saying, well, this part of it will work best in a recession, and this part of it will work best if we have inflation. And this part of it will work best, if we just kind of muddle along and we don't see high inflation, we don't see recession, so we kind of have this steady as she goes kind of thing. So in that way, you're not going to get killed. You may not be a hero, but you're not going to get killed either. And then as the year unfolds and as you start to get clarity, because I think you will get clarity this year, I think you're going to get clarity by the end of the year on whether or not we're going to have a recession, because the yield curve is going to uninvert. And that opportunity, what that message that it's sending you, it's got an expire by date, and it will expire. And if we don't get it, then you're not going to see it until the Fed starts tightening again. So you kind of reset the whole cycle. So I think you are going to learn things this year, not least of which is what the voters want their government to do for them for the next 4 years. You're going to learn that at the end of the year, hopefully. Although that could really be a mixed message too. So you never know.
Yeah, there are no easy answers.
No. So long answer, short question, but that's kind of how I'm thinking about it.
Yeah.
A lot of different things going on. And each of them can kind of drive the market for a different period of time. Right. So right now, I would say the fears of inflation out there in the market are very low. But I personally don't think they're that low. I think they're a little higher than the market is. So for a period of time, you may get a recession scare, you may get an inflation scare, you may get something else that's going to drive the market for a period of time. I can't say I know what's going to drive the market for the full year. So I look for good values. I place my bets carefully. I try to be aware of the different outcomes. I don't want to get too hurt if I'm wrong. You never want to do that. Accepting that I won't be a hero if my most likely actually unfolds. I'll look pretty good, but I don't think, I'll necessarily shoot the lights out. What do you think, Dan?
I was just actually going to ask Corey if everything Jeff just said in response to that question sounds like anyone you know anywhere around here.
I don't
prepare
know.
for a
Have I heard
variety of
any-
outcomes, good values. Don't worry about shooting the lights out, all of it.
Prepare for the possible outcomes. Well, before this interview, I was looking just at recent things that have been out there, either published by you or about you. And Business Insider tells me that you've beaten 92% of your peers in the last 5 years. And that was rumbling through my mind about how you're preparing for the different scenarios at any given time, even if that leaves AI gains on the table or whatever else it may be. So that's what I was thinking about there. And that seems to me like what you're saying right now.
I joined the business in 2008, right? That's when I retired from the Army, came to work for the family business. And so my foundational or formational experience with the markets was the crash of 08-09, right? I came in October, and I wrote a memo for my portfolio manager at the time in probably January of 09, recommending what we ought to sell. Market's been shit, and here's a list of things we ought to sell, because I was deeply afraid that the market was going to keep selling off. And a year later, and 2 years later, and 3 years later, and 5 years later, I look back on that memo and said, oh my God. At the time in my lifetime where you could buy almost anything and have a good outcome, I was on the sell side. I got to rethink how I came to say that and how I prepare myself kind of mentally to be ready for the next time around, should it occur, so that I can, in fact, say the right thing, which is, damn, things are cheap. Let's go buy a whole bunch of stuff. Good stuff, marginal stuff, right? Because it's all a little different. But this is a buy time. This is the after Christmas 50% off sale. So how do you prepare yourself to do that? But those times only come once in a very long time, right? And so I've expected it, I think, more than it's actually occurred since then. Got it pretty right in 2020. I didn't get the lead up to 2020. I frankly never thought the U.S. would shut down, right? That was not a possible outcome for me, that we would tell everybody, go home, stay home, we'll call you when it's over. That was amazing. So I was not properly prepared in terms of sitting on a lot of cash waiting for this to happen. But I think I did a pretty good job in March and April when things started to look better, to say, I don't know how this is going to turn out, but that's a really cheap price. And I know what to do now about really cheap prices. Like nonsense cheap prices is what I'm talking about. Right?
Sure.
Things that just, in a rational world, something selling at, 2 times free cash flow. Holy cow. I mean, you can make some pretty bearish assumptions about what's going to happen to that company, but 2 times free cash flow?
Right.
I mean, that's just crazy cheap.
Yep.
So do I think we're going to have one of those? I did. I did think we were going to have that period. I'm not sure we're going to get that now, right? When I talked a little bit before about the tech bust. I'm not sure it's going to play out like 2000 did, where you had this big bust and then you had a period of 2 or 3 years you could go pick through the wreckage. And why do I say that? Because AI and the excitement around AI and the money that AI brought back in highlighted to me that there's still a ton of money looking to go to work in that space. And nobody has had the stars, the excitement around tech is not dead. It was in 2003 and 2004 because everybody got burned. It's not dead right now. So is it possible that the Fed tightens enough and things go badly enough for tech that it destroys all those dreams? Maybe it is. but I'm not sure anymore. So I think you need to keep some cash, I think, and we do. We've got about 10 or 15% cash right now, looking for an opportunity to put it to work at really good values. But you've got to take advantage of the values you see today, too. And they're out there. You can find them. They're out there. And there are values in some things that aren't necessarily tied to the economic cycle. So if you don't quite know where we're at in the business cycle, that might be okay. Go look for things that aren't tied to that and see if there are places to put your money to work. And if you nailed it on the tech side, if you owned NVIDIA, my suggestion would be take a little money off the table. Triples in a year are pretty unusual. If you expect that to happen again next year, you might be disappointed. And my suggestion would be, take a little money off the table. Dan, you're smiling. I'm guessing you've said the same thing.
Yeah, I might even have said that, NVIDIA was like a terrible buy, $100 ago or wherever. I'm not sure where it is. I haven't looked at it in a couple of weeks, actually. But yeah, I'm skeptical. I'm skeptical of big expectations like that. Not saying it's not a great business or that they don't have this great position in the market. We're not saying, I never say any of that. In fact, I've written a bit about the Magnificent Seven recently because, hey, look, if you called it in late 2022, good on you. You got a hell of a run out of like Meta and NVIDIA and stuff. Great. Fantastic. Love it. And we have folks who worked for us. Whitney Tilson works with us, and he called Meta. He was all over that. So great. But now it was a trade. It was a brilliant trade. But now I think it's long in the tooth, and it's certainly not a good value. So, yeah, I would agree with you there. And I'd also say the whole Magnificent Seven is generally in that category.
I would agree. We own Microsoft and Apple, right? And in late 21, it looked like the prices were rolling over, and we were 25% tech at the time. And I said, at 30 times earnings, they're great businesses, but at 30 times earnings, that's above fair value. We thought fair value was 20 or 30, 40% lower than that. And they sold down to approximately fair value by October 22. And then they rebounded, which I did not expect, right? They never got cheap. At best, they got fair valued, and now they're back up at 30 times earnings. So to me, and we kind of did it, the best example I have personally is probably Baidu. So it's the only Chinese company we've bought since I've been here. And this was 2019, something like that. And it was selling to like 10 times earnings. And I'm like, it's this great, big, slow growing cash cow. Perfect. Something will happen. Sure enough, something did. So we bought it. It doubled in 6 months. And it, exceeded now my fair value. I said, okay, I thought I was going to get a double in 4 or 5 years. What I got was a double in 6 months. I got what I expected. It happened a whole lot faster. I think I'm ahead to just take that off the table and put it in my pocket.
Yeah, nice.
And that's kind of how, when what you expect to happen happens faster than you thought it would, that doesn't mean, there must be better things. There might be, and you need to think that through. It also might have just been that what you expected arrived sooner. Take the present, put it in your pocket, and go look for another opportunity.
Jeff, is it fair to say that the Muhlenkamp Fund reflect what you do as a firm, or is that just kind of off to the side?
No, the Muhlenkamp Fund reflects what we do as a firm. There's no significant difference between what we do with our individual accounts and what we do with the fund. They are run the same ideas. I mean, how do you look at somebody and say, well, I gave you the second best idea because, you're in the fund or not in the fund or whatever the case may be. No, they all get our best ideas unless there's something specific in an account that says, we don't want X kind of investment.
Right. Some people run different strategies, but I'm glad we made that clear because one, I've got your top 20 on my screen in front of me from your website.
Okay.
And the one that really made me smile the most was the Spider S&P Regional Banking ETF. I was like, I'll bet I know when they bought that.
Not as good as I wish we would have.
Well, yeah, who does, but still.
But yeah, I think there's opportunity. I cautiously think there's opportunity in the regional banks, right? I think the problems they're facing are real. I suspect at best it's going to take them a while to work through them, both in commercial real estate and with, the value of their bond portfolios. but some of the pressure on the value of the portfolios just came off, right? When interest, the 10-year just came down from 5 to 4. So that helped a little bit.
Mm-hmm.
And I also, it was very clear to me, the message that the Fed sent back there in March and April when Silicon Valley Bank went bust. They immediately found a way to send money to the banks.
Right.
Immediately. There was no delay. There was no, moral hazard. Nope.
Right. For all depositors too.
Correct.
Yeah.
They did a lot of things to help them out. And so I think if you're careful, and of course, KRE is a broad brush, if you will. But yeah, we're interested in that space. I think there are some opportunities in that space. That's one of the ways we've tried to take advantage of that, and we're looking for others. Is probably the best thing I would say, about KRE.
Right. Well, in keeping with your "don't worry about shooting the lights out" comment from earlier, with KRE, you will capture whatever happens in that space, right? You'll capture it.
Correct.
You won't.
Correct.
You might not get you won't get the benefit of like the best performer, but the best performer will affect the performance. So I think that's a great bet for that type of bet, right? You almost don't. You better be a good bank stock picker. In other words, if you're not just going to buy
banks are always tough.
Yeah,
banks are always tough,
right?
Because you never quite know what their asset quality is.
Exactly.
You never know how good those loans are. You never know how good the underwriting was, because you don't know the details and you don't know exactly who they lent money to or what their collateral is.
Right. That's why I like this, because you know the whole sector isn't rotten. Right? Every bank isn't rotten. Every regional bank isn't rotten, and you rely less on individual stock picking, which in that one case I think is kind of the way to go. Is there anything you've added recently that you want to talk about?
I think maybe the most interesting one is Tegna.
Tegna. Oh, no kidding. Yeah.
So Tegna is a broadcast television and radio station company. And they were going to be taken private, and that deal fell through. So they got a windfall of cash from the failure of the deal. They're selling it, 6 or 7 times earnings. They committed to send most of that windfall cash right on through to the shareholders. They up their dividend, they up their buyback authorization, that sort of thing. And most important probably is the fact that they really run on a 2-year election cycle, because of the impact that political parties and political advertising has on their business. So they judge themselves on a 2-year basis. Well, the market seems to be judging them on a we don't ever want them kind of a basis. I don't know. It's really cheap. But I think they're probably set up for a great revenue year this year. I think there's going to be more money spent in the next 12 months on political ads than there's probably ever been spent. And I think they'll participate in that. So in terms of, has nothing to do with the economic cycle. It runs on a very different cycle. It looks cheap. They seem to be doing smart things with their cash. I don't think they're going out of business. To me, that's an opportunity that is very much idiosyncratic from all the other stuff that the market is thinking and talking and doing. Right. So to me, that's a little bit unique and probably worth talking about. Right. So we think we'll get a decent return out of it.
It is worth talking. It looks to me, just like glancing at the chart, it looks like the deal fell through earlier this year, like March or so, and it's gone like sideways since then. So,
correct.
It's still a bargain if you view it as a bargain.
Still a bargain.
Wow.
So we think that one will probably work out. The other one that I might bring up, BGC Corp. They are a broker dealer, right? And they've brought out some products with automating primarily sales of assets in the fixed income industry. And they used to be a partnership, right? So Lutnick is the CEO. I forget his first name, but they had a very limited. Thank you, Howard Lutnick. And they had a very limited shareholder base when they were a partnership, right?
Right.
But Howard decided he's a majority owner. He decided that they would go full C corp so they could open that up, and they did that last summer, and that's about the time we bought them. And the other interesting thing that's happened is if you've listened to the earnings calls the last couple of quarters, Howard has been very emphatic that what had been a no growth business during the decade of low interest rates is now a growth business again. So now that interest rates have come up off the floor and they're volatile and higher, he gets a lot more business as people are trading a lot more in fixed income. So his normal business is back in a growth mode, as he puts it. And he's got kind of a call option. I think, if I remember correctly, he's standing up an automated options trade platform that's about to get approved here probably in the next 6 months. So he's about to announce who the partners for that are. So you've got some near-term catalysts. So for about 3 different reasons, and oh, by the way, when we bought it, was selling at like 7 times next year's earnings, right? So cheap, generating a lot of cash, 2 or 3 catalysts for why it ought to attract Wall Street's attention. And if it did, if it just went up to a market multiple, you're looking at probably a double, maybe a little better. So that looked like a good setup to us, and we put money to work again 6 months ago. And it moved about 50% for us since then. So some of that opportunity has been realized now, but there's still a fair bit there for people that are interested in taking a look and kind of making up their own mind about it.
Nice. That one has made it into your top 20. Did it appreciate its way in there? Or did you take a big stake?
We had to work our way into that a little bit. So I think we probably own, I don't know, it's probably about 3% of assets right now, something like that, which is pretty typical.
Hey, Jeff, this may be a simple question, but how do you personally go about screening or finding for these companies? There's a lot of businesses out there. How are you finding the ones that are below 10 times earnings or whichever ones you're interested in? I mean, what's your kind of process on a?
It's actually very manual, right? So I haven't found a way using computer screens to actually, because when they're the most interesting, they usually fail something, right? They usually fail some broad. If you go price to book, that gets you one place. If you go PE, that gets you another place. Or there are just so many kind of different things to it. So I haven't found a screening process that works. But what we do, we run what my dad started the business. Started in the business in the 70s, and he became a user of Value Line product. If you're familiar with that, Dan, I think you might be.
Yeah.
They send you out an edition every week. They cover basically the whole stock universe every quarter.
Mm-hmm.
And so we still receive those. And what we do is we pull key data from that and we run it against our model. And so Ron created a model that uses inflation and return on equity as primary inputs to just kind of rough out a value for a company. And so we build that into a spreadsheet, and we generate that spreadsheet every week, and we just manually walk through that edition of Value Line with our spreadsheet, with the Value Line information. And I usually use the Bloomberg terminal, and I have a couple of different kind of screening charts that I will look at. I like to look at net margin over the last 10 years. I like to look at ROE over the last 10 years, price to book, price to sales, and free cash flow, right? To see what the trends look like.
Yep.
And then you go through that and you say, in this edition of 200 or 300 stocks, these 4 or 5 look really interesting, right? For whatever reason, there's something stands out. They're particularly cheap in one aspect. If you're looking at banks, you're always looking at price to book, right? So you're looking at price to book, below book, and usually they all run together. But you're looking for that sort of thing, and then you start digging. Plus, we read a lot of other newsletter writers. We read a lot of other people, and when they say, "Hey, this looks kind of interesting," we say, "Oh, that kind of does. Let me go do some homework." So you cast a wide net, but we do have a systematic portion of that. We kind of have an idiosyncratic portion of that. I'm a subscriber of Stansberry. I read what you guys write. Sometimes it looks pretty interesting. Sometimes not so much. But as far as I'm concerned, it's about the cheapest way I can hire analysts that I know of. You guys are all working for me, and you're generating ideas, and I get to accept or reject them at a pretty low price. So, as far as I'm concerned, Stansberry is a great gig as a subscriber doing what I do. So I hope that answers your question, Corey. It's
Yeah, for sure. Makes a lot of sense.
multifaceted. But you have to know yourself.
Yeah.
There's a lot of ways to make money in the market. And you don't even necessarily have to have one thought process, but you have to know which one you're using for the investment you're making. So if you're saying, this is going up, it keeps going up, I think it's got a momentum. Well, that's great. Invest as if it has momentum. And when it looks like the momentum's coming off, don't change your mind, because now you're going to use some other metric. Right. If you say, I'm going to play the momentum game on this stock, great, do it. And then when it rolls off, sell it and be done. If you're going to play value, which I tend to prefer, right? And you say, okay, well, when it gets to fair value, we're done. Don't be careful about changing those metrics. Typically, what we do is we buy value, and then when it reaches fair value or even over, now we start looking for momentum. And when the momentum starts to fade, then we got nothing to hang our hat on, and we sell. And also think about the time frame you're interested in. A lot of what we buy and sell, I would say, kind of run on the business cycle. And so your time frame is the business cycle. If you're going to play a multi-cycle time horizon, that will lead you to different, particularly sell decisions, right? And the example I would use from our experience is Rush Enterprises, right? So Rush Enterprises, we bought in the early 2000s, 2001, 2002. They're a distributor of trucks and a repairer of trucks. And Rusty Rush is a hoot. If you ever listen to his calls, he's great to listen to. But they are a consolidator of the industry. So we've owned them now for 22, 3 years. Our cost basis is below $1, and it's now at 50. So what we did there is we found a company that one way to play it would just be on the business cycle, because their earnings are cyclical. And it's a cap goods company, right? They sell trucks. And so earnings come and go. But what he did was he started making the company less cyclical and more profitable on the parts and services end of things. So what he calls his absorption ratio, the money he generates just with parts and services without selling a single truck, now covers 120 to 130% of his costs, right? So he calls that his absorption ratio. So we decided it's a great company doing great things. We're going to ride it through more than one cycle. And we've been extremely happy with that, right? So it's a little atypical. And that's where I get to, we could have bought it one way, but don't shift horses, right? If you're going to hold it for the long term, don't sell it at the end of a cycle. Another one for us is probably Broadcom, right? It just had a nice double last year. It's still a fabulous company, in my opinion. So I'm okay. Now, we trimmed it. We trimmed it in late 21, but I'm okay holding it through this boom bust phase, which I think is going to occur in its price. And I'm kind of mentally prepared for that, because I think they will continue to compound their earnings going forward. And I can live with that. Berkshire might be the same way. But think about what you expect the company to do. Think about the time horizon that you're interested in, and then recognize you will be able to recognize some of the problems you're going to see if you follow that plan, particularly if you got a longer time horizon, right? So, if you're Microsoft, if you say, I think Microsoft or I think Apple have great 10-year futures. They're huge cash generators. They're going to have a new product sooner or later. I just don't know. Okay, recognize that they will not look so good at some point when their existing product cycles all kind of mature, and then there's going to be a lag. Just recognize that, and don't necessarily get discouraged. Certainly, when that happens, you're going to be looking for, okay, what's next? Was my thesis of 3 or 4 or 5 years ago still playing out, or has something changed? Have they changed how they run their business? How they changed how they invest their profits? But kind of be prepared for that. So, kind of know what game you're playing, play it as best you may. And if you're going to change games, think about it really hard before you do that, because that's where you can really get yourself in trouble.
I loved it. We're like brothers from another mother. When you say, be yourself, you started saying, be yourself and know yourself. And I've written a lot of words to our subscribers on exactly those themes. It's so important to know what kind of investor you are. And I think some people don't. They say they'll buy anything they heard about at a cocktail party and not know why they own it. So I love
That
that
can be
answer.
tough.
Yeah. Whew. You just, when you don't know what you're doing, things don't come out right, But it's time for our final question already. And you answered this once before. I hope you don't remember it. Do you remember it? It's the same question on every show.
I'm afraid I don't. I'm sorry.
Good. It works better that way. Okay. It works better that way because the final question is simple and it's the same for every guest. No matter what the topic, even if we have a non-financial guest on the show, I still ask them this identical final question. And it is, if you could leave our listeners with a single thought today, what might that be? And take as much time as you like.
Okay. Yeah, I remember that question now. I'm trying to remember what I told you last time. Enjoy your life as best you can. It's not all about money. Money is often a part of it, but money has a purpose. Don't get lost in the game, particularly the game of the Wall Street game and all the different players and all their different agendas. But remember what it is that you're trying to do. And if you set yourself up to be able to do those things, that is a win, and rejoice in it.
That is a great answer. We're getting more of those sort of, non-financial specific answers. But you said you don't know what you said last time. You actually started out saying, don't risk money you can't afford to lose. And then you expanded on that. So I love this answer. And I love, we've gotten a few of these. We seem to be getting more of these over the past year or so. And, it's wise stuff. People like you who've done as well as you have, been in that particular business for that long, they gain a kind of wisdom. And it reminds me, it's Munger-esque, actually.
Yeah,
that
and
answer.
I'm going to miss him.
Yeah. I mean, talk about a wise old investor.
Well, I just love the way he was straightforward in his answers.
Oh, yeah.
He did not prevaricate. He did not tap dance. The man told you what he thought, and that is uncommon. And I always found it refreshing, and I will miss him.
Yep. All right, Jeff. Well, we hopefully will not miss you too long before you come back. It's always good to talk with you. Thanks for coming back to see us.
Well, thanks, Dan. Thanks, Corey. I enjoyed it, and I look forward to the next time.
All right. We'll talk to you then.
All right.
NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular on many major news outlets from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzyreport.com. Again, that's www.aifrenzyreport.com for a free copy of his new report. So the answer is yes. I do love it when I get a guest on the show whose investment process and thoughts and general orientation resemble my own in many ways. So if you're wondering, did Dan have Jeff Muhlenkamp on there because they're both value guys and they see the world a similar way and do a similar thing? And the answer is absolutely yes. Of course, I know more of those people than anybody else. But I hope over time you've seen that we've gone way beyond value investors and we've had all kinds of people on the show. And also, Jeff may be a value investor, but there's no such thing, I hope you've learned on the show, as just another value investor. He has a whole, like when he's talking, it's Jeff Muhlenkamp. And when somebody else is talking about value investing, it's them. So value investing is this huge, broad way of thinking. And then Jeff described, the way he thinks about specific ideas from the bottom up. And I'll tell you what, he got me interested in Tegna. And I looked at that stock chart. I thought, okay, the thing is actually about 5.5 times earnings, and it's gone nowhere since the deal fell through. You better believe I'll be spending time on that one. So, and I knew Jeff would do that. He would pull an idea out that would get me excited. Do you have any thoughts, Corey?
Yeah, I mean, if you're a value investor or interested in value investing, it'd be silly not to just listen to him talk. And he was very open and willing to share how he goes about things. And I really love this point about trying to find, or the value in finding businesses not attached to the business cycle, like a Tegna. And I'm glad he brought that up, because I was going to ask about it, which, for an example. And what you just said, it being, knowing yourself and knowing what you do and what you're in for. But obviously he's so aware of the business cycle, and, it brings up the U.S. debt, which you wouldn't associate, which you might not be the first thing that you think of with a value guy or gal. So yeah, I love listening to him. Hope we have him back on in another 18 months or so or less.
Yeah, definitely. He'll be getting a call from us. And I'm just looking at some of the numbers for the Muhlenkamp Fund. Holdings turnover is 15%. Basically, if they turn over the portfolio at this rate, it'll take 7 years to kind of sell it all and buy new stuff, approximately something like that. So, most people, like, their turnover rate, some of them is like it exceeds 100%. I mean, it's just like crazy. And he's got those companies in there like Rush that he's owned for eons, like decades now, which is really cool. And Broadcom, and those are both in the top 20. I think that's really cool. It's really cool to find somebody who's capable of that long-term of a perspective. And I'm glad he shared some of the specifics about the businesses. He's a great value investor is what he is.
Yeah. And I would say if anybody who's not aware of him already, just look him up and see what I mentioned about him beating his peers is true. He's been, he's consistently in the top performing funds out there. So grateful to talk to him.
Yep. And you can learn more at their website, muhlenkamp.com, muhlenkamp.com. I spend some time there now and then myself because I like to look through their portfolio for ideas. So, and Tegna wasn't in the top 20. I didn't know about that one till today. All right. That was great. That's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.